Hey guys, it's Tyler again with a quick video explaining a little bit more about how money is made off of buying and selling stocks. So first we're going to talk about dividends. So when you hear stock dividends, you probably think of this card from when you were playing Monopoly. The chance cards that say bank pays you dividend of $50. Well, that's actually pretty accurate, and we're going to explain why. So, how a stock dividend works is this. If you own a portion of a company, which is stock, if you own shares of that stock, there is a chance that the company offers dividends. What it is they pick a frequency per year, for instance, 4 times per year or quarterly, that they will pay out a portion of their revenues in the form of cash to their shareholders. So I want to point out a couple things with this real example. This is Procter and Gamble, and this is a real example of a stock that I bought and then sold. If you'll notice in the green squares marked with a D, that's each time the company paid a dividend of 67 cents per share. So if you owned 100 shares, you would have gotten $67 and you would have received that 4 times. Now, the reason this is important is because it can greatly increase your return. So from owning the stock for 10 months, my capital gain was 16.9% on the money that I supplied as capital or in other words, buying at the entry point of $74 and then selling at the exit point of $86. And you can see below that the capital gain plus the dividends was an actual return of 20%. So it can make a big difference if a company offers dividends or not. For one, if the stock went nowhere and if you were to buy and sell at the same price, you would actually still earn 3.1% return on your investment. So that can be a great hedge against inflation. It can be a great hedge against a flat market like we're seeing right now with the S&P trading in somewhat of a channel. Here I want to explain why your return could differ if you reinvest your dividends versus if you don't. What I mean by that is reinvesting is when you receive your dividend check and you buy more of the stock or ETF or mutual fund that is giving you your dividend. And what that does for you is you buy more shares, and then since you're paid the dividend on a per share basis, each time you reinvest, you'll receive a higher value of a dividend the next time. So if you're constantly buying more shares from the money that they're giving you just for holding the stock, over time you accumulate more and more shares even if the price of the stock is in decline. And basically what this does is it makes your money work for you, since your money is earning interest on interest. And Warren Buffett actually tries to explain this in his book, The Snowball Effect, of how you can make your money work for you. Lastly, I just want to show you guys this resource you can find on NASDAQ.com. That's where I go to find all my dividend tables. This is a dividend table, and basically what I've circled there is called the XF date, or other places call it the XDiv date. And you have to own a stock before that day to actually receive the dividends. You can't buy the stock on that day. And I learned that the hard way. I had a professor tell me wrong. So I just want to help you guys out. Secondly, that box there, that is how you know how much of a dividend you're going to get. For instance, here for Procter & Gamble, it was 67 cents per share that you'll receive in cash to your account whenever you hold that dividend until the date that it says there, the ex-div date.